Good afternoon, everyone, and welcome to our third edition of CFO Insights. Today, we are lucky enough to have Jim Mackaness join us for a lively conversation on business intelligence and how it informs our critical decisions as CFOs. Before we begin the conversation, let me tell you a bit about Jim and his background. Jim joined FLG Partners in 2019 with over 20 years of experience as both a CFO and a chief operating officer in both healthcare and high-tech industries. He is a strong business partner to his companies, and he leverages data and business intelligence to drive data-driven innovation, growth, and process improvement in his companies. Prior to joining FLG, Jim was the CFO at Invuity, a public med tech company acquired by Stryker, and COO and CFO at Iridex Corporation, a public med tech company that delivers laser and other solutions for the treatment of certain eye conditions, for example, glaucoma. On the tech side, Jim was the CFO at Next Hop Technologies, which was focused on licensing network software to OEMs, and InfoGear, a software client-server platform company that was acquired by Cisco. Jim started his career as an accountant at E&Y and also has a degree in psychology, which comes quite needed when you're a CFO and working with teams across the board. So let's begin our conversation and welcome Jim.
Thank you.
So first off, Jim, how did you first become aware of business intelligence? Was it your actual use of such data to answer a question or resolve an issue, or was it merely accidental?
I think it was more accidental. The first instance I remember was when I was a senior at Ernst & Young, and I was on an assignment where I was responsible for managing a large team at the client site for 3 weeks, completing all the audit fieldwork. And we'd compiled vast amount of data and results. And at the end of 3 weeks, the partner on the account came out to visit, and I had everything prepped and ready to go, and I was feeling really good. So the partner comes into the conference room, and he sits down and he looks across the table at me and asks, "So Jim, tell me, did XYZ make a profit or a loss for the year?" And I remember being completely stunned. We'd done all this work, had all these facts and data at my fingertips, but I'd never once considered putting all the pieces together in one simple picture. I'd never considered whether the company had made a profit or a loss for the year.
So Jim, what did you do? What did you tell the partner?
Yes, well, after what seemed like several minutes of silence, I leant forward and mustered up as much conviction as I could, and I said, "I honestly don't know, but I do know that whatever it is, it's right." And then, of course, I hastily dug out the files to find out what the real answer was. But that's when I realized that, data, no matter how correct, was pretty useless without context.
That's hilarious. So as your career has evolved, what do you experience today as a CFO in the finance function as it relates to BI? Meaning, what are you seeing about business intelligence, its availability, its access, its use by teams?
Yes, well, I continue to see that a gap exists between the need for BI and its availability, particularly in startups and smaller companies, even if they're public and they have limited resources. The focus tends to be just on closing the books, and there may be little or no financial planning and analysis expertise. So this is where I think this is an area where a CFO can really add value. For example, in my experience, it's common to have a monthly or quarterly close review with the controller and the accounting side of the house. This typically slants towards the balance sheet focus. The controller and the accounting team, they review all the balance sheet accounts, and they walk you through the analysis of the reserves. They express confidence that all the closing balances are accurately stated because their focus is on compliance and satisfying the external auditors.
Right.
As the CFO, I need to know how the business operated for the quarter in order to give me the business context to be able to understand the data. And not just in terms of historical trends. Revenues may be up 10% over the prior period, which sounds pretty good. But if the plan was up 20%, then that's not so good. So as the CFO, this is where I think one can help connect the dots.
Mm-hmm.
The flip side, occurs if you look at the monthly close from the FP&A team's viewpoint. While the team might point out variances between budget and actuals, often there'll be limited or no explanation of the root causes that give you insights as to why. And often their view ignores, the balance sheet side of the equation and possible capital needs. A key here is that CFO can help to offer a more holistic approach for figuring out the data, to make sure you understand what it's telling you about the business and how it's performing. And then you can use this framework to discuss the results with the CEO and other members of the leadership and the board. You know, the value the CFO provides is in truly understanding how the financial engine works, you know, knowing how all the components fit together, discovering what makes the engine run hot or cold, and what can be done about it. You know, sort of in this analogy, I think of the CFO as effectively, you know, the company's head mechanic.
I love that analogy, totally get it. I think what you're saying is that the CFO needs the whole picture, right, of how the engine runs, as opposed to just the parts. You need the sum of all the data. Totally get that. So Jim, give me a current example, particularly in this COVID environment, so to speak, of how you as a CFO has used BI successfully in the practice.
Yes, well, I think, so when COVID hit, for example, our team at Iridex, we immediately jumped into scenario planning, and I'm sure most of us did in the audience, most of the audience did. From us, our point of view, we were a company that was not well capitalized, and so we didn't have deep pockets to weather the storm. So understanding the impact of lower revenues and projecting expenses to forecast our cash runway was going to be key to the company's survival.
You bet.
So we ran different downturn revenue scenarios and expense reduction programs. And logically, as shown by the models, a smaller business requires less working capital, and this projection reduction in working capital is going to mitigate some of the cash burn. But this raised a couple of key questions. Firstly, not all revenue is created equal. Part of Iridex's revenue comes from the sale of capital equipment and part from per procedure products. Although we expected all the revenue to fall off the cliff in April, we could not just assume that all revenue would bounce back at the same rate. Revenue from capital sales might bounce back quickly once COVID effects were over and behind us, but per procedure revenues not so much. It's quite different. If a surgery is cancelled as a result of COVID, there's only a finite amount of operating time in any month in the future, so you don't really get to make up for lost business. Your whole revenue curve kind of slides out, if you like. So to accurately calibrate our financial scenarios and possible business outcomes, the finance team, we worked closely with the sales team to really understand what they were seeing in revenue patterns. And this was critical to the business recovery at Iridex. The second really important thing was working capital. The forecasted contraction in the business, rolled through into a reduction of working capital, notably inventory and AR. However, at Iridex, we have a fairly long lead time in supply chain, so you can't just turn off the taps off an inventory. You have purchase commitments that are out there with vendors who are building inventories to your pre-COVID forecasts. Without a quick response on our part to adjust these forecasts and actively work the supply chain, the risk was the company's inventory balances were going to balloon up and suck up precious cash. So with this knowledge, we aggressively moved to working our supply chain partners to mitigate against this happening. In some cases, we were able to push out orders. In others, we prepaid for raw materials that our vendors had purchased to keep them whole, but to avoid the additional costs of turning the raw materials into finished goods. With regards to AR, reduced sales typically translates into reduced AR, creating a positive cash effect as less cash is tied up. However, with COVID impacting everyone, we quickly saw that we might not be able to count on customers to pay their invoices for the pre-COVID business. So would AR aging increase and our cash balances start to decline? We immediately dedicated resources to managing our AR, reaching out to customers on a much more regular basis to either successfully collect the cash or, in rare instances, become aware of specific collection issues and take appropriate action. So, these COVID Iridex examples, our team worked through revenue expenses, working capital impacts. That kind of illustrates the value a CFO brings in understanding both the financial engine and the data in the context of the business, and how a CFO's knowledge and leadership can leverage BI to drive the right actions. That's the key thing, driving the right actions to create better business outcomes.
I think those are great examples, Jim, because so many of the CFOs of companies today and members of our audience are dealing with the same types of issues. So great examples. So shifting gears a bit, can you provide some stories for our audience from your own experience where different company situations from a BI perspective drove very different or maybe even radically different answers. How did you as a CFO use business intelligence data to help drive the company decision-making and success in the right way?
Sure. Let me build on my analogy of the finance being the engine of a company and provide two different examples. I'll call it the Ford versus Ferrari analogy.
Got it.
So the question is, what do I mean by Ford versus Ferrari?
Right.
Well, so let's say a Ford engine running at 50 miles per hour suggests the engine is running at close to optimal output. Conversely, however, if you're lucky enough to have a Ferrari, if the Ferrari engine is running at 50 miles per hour, you probably haven't got out of second gear yet. So, the analogy holds for BI. The same financial data could and should, in the two different business contexts, lead to totally different actions. So the key for the CFO must be able to view the data in the correct business context to ensure that the business is taking the right actions to create the better outcomes. Mm-hmm. You asked for an example of how BI can drive radically different results.
Yes.
I'll go back to Iridex for a minute. So I joined Iridex back in 2008 for my first tour of duty, just after the company completed an acquisition, which most unfortunately had almost driven the company into bankruptcy. So initially the idea was we had to right the ship. So we focused on righting the ship, and then we had to decide how we were going to rebuild shareholder value. One way to rebuild shareholder, sort of the typical way, is to invest in revenue growth, sort of build a Ferrari. Mm-hmm. However, Iridex operated in mature markets with mature products. So we decided that a better strategy was to leverage our strong cash flows post-bankruptcy. So we focused on building a Ford. We managed our working capital to aggressive targets, and we set lean expense budgets focused on generating excess cash, which was our key objective. And then we implemented a share buyback program. And as a result, we were able to drive the share price from less than $1 to over $10. In contrast, to this example was my experience at Invuity, where we faced a completely different scenario. Invuity was a freshly minted IPO with valuations based on significant revenue growth.
I remember.
Yeah, here we were building the Ferrari. Here we needed to tune up the metrics to allow for support rapid revenue growth. Relaxing working capital constraints, forward investing in sales and marketing, even if this meant running at a loss. We knew that the revenue growth would allow us to continue to access capital markets, providing the fuel for the company's financial engine. And in the end, by focusing our efforts this way, we were able to build a successful company that was purchased by Stryker. Mm-hmm. So, the bottom line, the financial data we used at both Iridex and Invuity had significantly different interpretations and meaning, given the nature of the business and the strategies of the two companies. So without the right business context, the CFO, as that head mechanic, is going to be making the incorrect assumptions and provide the wrong guidance into the C-suite and the board.
Those are two great contrasting examples. So thank you, Jim, for that. So my next question is about how you build business intelligence capacity within a company. So start, Jim, with what BI capacity looks like in the startup world with a startup company, and then tell us how resources grow in larger scale companies with regard to business intelligence. Lead us through that.
Yes, okay, yeah, understood. Yeah, because regardless of the company's size, to increase the level of business understanding or intelligence, you need to understand both how the business is doing versus your internal KPI metrics and plans, and how you're doing regards to your market penetration and competition. So it's an inwards and an external viewpoint. I think as startups and small companies, to build BI capability, you have to start somewhere, even if you have few resources. So you do have actual company results, so there's a place to start. And you can also create or leverage some level of FP&A. You can begin building out a financial model and create a budget if one doesn't exist. I'm also a big fan of making sure you invest in the right tools along the way. Sure, you can start with Excel, but that's very labor intensive, and you really want to try and create efficiency in the data gathering side of the equation. So I'm a big fan of adaptive insights.
Love adaptive insights. Great tool.
I agree. So I think it's just really important on the planning side and so easy to use. Because as I said, you just want to increase the efficiency there so that you can spend more time on analyzing. And then you'll often find other functional areas are developing their own data sets. So it makes sense to make sure you're listening and teaming up with, say, marketing to buy market data or competitive data. This helps with market sizing and market opportunities. For example, in medical device companies, I think having data on surgical procedures is critical. In biotech, it could be patient incident rates. Now, as the company gets bigger, I think it's important to draw these data sets under one umbrella to make sure there's one source of data and agreed upon semantics to avoid the confusion or disagreement. And I think the CFO is an ideal candidate to sort of head that organization up. Because the key here is you're trying to avoid the type of meetings I'm sure we've all been in, where the finance team represents one set of numbers for revenue and based on how revenue is recognized under GAAP. And then the sales team represents a different set of numbers because they're looking at business books. And you can't get the meeting started until everyone gets on the same page. So when I say one set of numbers, much to the shock of the finance team, it doesn't have to be GAAP numbers. It's whatever makes the most sense when you're talking about your business.
But I totally agree with you that one source of truth is so important, and that's why it's smart to have BI under the umbrella of the CFO. So you own all of the data and you see it all. So cannot agree with you more. So now let's turn to using BI as a tool to build a strategic plan. So how do you turn ownership for the BI function, Jim, into a company-wide process to help build a 3 to 5 year strategic plan that's both realistic and robust? And then how do you use the plan to drive better company performance? Tell us about your method to that madness, so to speak.
Yes. So now you're hitting on my passion, if you like. This is for me. I'm a bit of a planning wonk. So this is what I really enjoy, sort of trying to help lead or certainly support in a company. So I always think it's the planning. It's all about the planning process. That's the central goal. So you're trying to establish a planning cycle that has two components that incorporate the business intelligence. So the planning cycle, you're looking to establish a planning calendar, a planning cadence, if you like, that runs through the company. So in this process, as I said, can be driven by the CFO and the finance teams. What you're really looking to do is you're looking to establish muscle memory, if you like, within the leadership and across the whole company. So for me, for example, a typical planning cycle might look like, let's say, June through September. This is where basically the planning team, finance team works with other cross-functional areas to create the 3 to 5 year strategic plan. The classic exercise that comes to mind is you imagine where you want the company to be in that future period and work backwards. Key players will tend to be marketing. You want to look at the existing markets and establish market opportunities and growth potentials to create TAMs. You want to map that to product development, review existing products and possible new products. So you're creating or leveraging the product roadmap. Then you need to assess from the sales side, are you going to be entering new markets or new geographies? You're going to reach new customers with new products. So creating a sales channel roadmap.
Right.
And then the key thing there is you're really going to make sure that you put all of that, incorporate all that into a financial model that demonstrates a level of financial performance that the leadership team believes will create an attractive increase in shareholder value for existing shareholders. Or in the case of a startup, you want to be able to attract the new capital into the company. So that's your June through September. And then, maybe there's a board presentation. And in October, what you're going to do is you're going to basically take the strategic plan to establish the key corporate objectives for the next year. So again, imagine now it's December 31st of the upcoming year, and you look back and you say, okay, what are the important goals that we need to be able to check off to show that we've made the progress towards the strategic plan? One CEO I worked with, he used to call them the vital few. And I love that term.
Love that term. Totally get it.
Really, really gives you the image, the vital few. So it's 3 to 5 cross-functional corporate objectives. Typically the vital few will include, say, your market penetration or customer adoption rates, a new product introduction maybe a clinical trial, business acquisition, and obviously certain financial goals. For example, you may have a revenue target, a profitability EPS target, or if you're burning cash, a certain cash burn for the year. So the vital few, again, is where data comes into play. because now you're going to define the KPIs or the appropriate data and the deadlines and timelines that the leadership team will use to measure progress throughout the year. This is why it's so critical for the leadership to agree upon before, the semantics. So you're all aligned as to, yeah, exactly, how this data is going to be used to measure. And part of all this process is you're looking to, quotes, get everyone's thumbprints in on the plan. You don't want this to be finances plan. You want it to be a company plan.
Agree.
Yeah. And so then I like to capture the vital few in a one-pager, literally a one-page PowerPoint. States the objectives, the timelines to each objective with the measurements you've agreed upon and the data points and when you're going to have these checkpoints. So everyone is on track. And then everyone in the leadership team should have a copy of the one-pager. And personally, I like to communicate this as widely as possible within the company to ensure everyone is literally on the same page.
Absolutely.
And then if you've got that, now you're basically in November and December, and you can take the vital few to create the resource plan or the budget. You start obviously by prioritizing the vital few. You make sure they're fully resourced. And then there are going to be other objectives and projects that are ongoing and necessary. So you look to resource those. And then at some stage, what's going to happen is you're going to basically run up against your financial constraints. So, you negotiate your way down, if you like, the shopping list. But the most important thing is you've established and fully resourced the vital few. They sort of become the prime directive, if you like, for next year's actions. And then the planning cycle continues into the next year. You establish a business review meeting once a quarter. And the leadership team gets together and you literally go through the vital few and have people comment on how they're progressing, look at the KPIs, other data readouts, and make sure that you're staying on track, or more likely, you're going to find you're a little bit off track, but it allows you now to understand how you want to react. What's the correct way to reallocate resources to get things back on track? And so at the end of the year, you have been successful in executing your strategic plan.
I thought you gave us a great example of the cadence that you use, Jim, in terms of how you take the BI, incorporate it with financial data, with a tool like an Adaptive Insights, and then from there you build a strategic plan and get everyone on board. So I think for our audience, that was a great look at the cadence that you follow. So thank you for that. So we have one last question because we're running out of time, but it's a fun question. So tell us, have you ever worked with a CEO that just said to you, Jim, give me a break. I don't get your strategic plan, because he or she did not believe that underlying business intelligence that you were using to inform your analysis. So that the CEO that thinks that your plan is way too conservative to show to the board and that sort of thing. So tell me, what do you do in that instance? How do you persuade that CEO that, yes, in fact, this plan makes sense and it's supported by the data?
Yes, no, I'm sure it happens. I mean, the goal in the strategic plan and the corporate is to get alignment through that process. So hopefully you work through those roadblocks. But to your point, what's happened to me for sure is after you've got everything lined up and you've supposedly got all this buy-in, you've got the corporate objectives in place, budgets rolled out, and key metrics. And then, we're coming in this situation, I'm thinking we're coming to launch the product, which is what we'd anticipated doing, but there was excellent buzz around the product. So all of a sudden, the CEO basically interrupts everything and says, we have to do $20 million in sales in the first year launch. The product will literally sell itself. And this suddenly becomes the most important thing. And I'm just thinking to myself, firstly, there's no way we're going to be able to do 20 million in sales. I mean, the product in question here was $300 million, $300 a piece, and the total business was only doing 30 million. Secondly, I'm thinking the ops guy is going to go and buy millions of dollars of inventory, and we might be stuck with it forever. And the sales team is going to completely take their eye off the ball and they're currently focused on. So even if they do sell 20 million of this new product, we're going to give up 10 million of other sales. And so all of this is going through my head, and I'm thinking, all the other corporate objectives are going to get pushed to the side, and we're going to sacrifice making progress on the other areas, which we had all determined were important to our strategic success. However, on the other hand, it was a big, hairy, audacious goal, and who was to say we couldn't or wouldn't do it? So in this situation, my approach is to try and find a way to sort of accommodate this goal into the plan, as
Smart.
opposed to have it, destroy the plan. So, so in this case, what I did was I thought, okay, we'll fold this in as a stretch goal. So even given my concerns on how unpredictable new product launches are, let's create a low, medium, high, and the high kind of incorporated the 20 million. And then you have to iterate quickly. So as soon as data becomes available,
So you're saying, you have to iterate quickly in terms of the stretch goal, the normative goal, and then the low goal.
Yes, as soon as data becomes available, you have to really sort of incorporate that into how are you actually progressing. So I spent time with the operations team to make sure we clearly understood, the purchase commitments, and we were able to support the various scenarios. Closely worked with sales leadership to understand what we were seeing in the market and to make sure we weren't overweighting the new product to the detriment of the others. And in the end, the product was a huge success. We didn't do the 20 million, but we did sell more than 10, which was higher than I would have predicted at the start. So, the big, hairy, audacious goal did have a benefit to the business. And by folding it in to our planning approach, we were able to deliver on that and our other corporate objectives.
And then again, I think a great example for the audience, Jim, of how you take kind of the CEO's thoughts of, you're being too conservative, and say, whoa, 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 I think our plan is right on, but let's build your ideas into what you call the stretch goal, right? And then always also have a low plan C just in case. So I think that's a very smart way of playing how you present a strategic plan and keep the CEO in line, so to speak. So we've run out of time. So thank you, Jim, for your insights today. I think you were a large help to our audience, and I know that they appreciated the conversation. And for the audience, we will be returning in October for another discussion on financings and how a CFO can lead the process and make it successful. Lastly, I just wanted to make sure that everyone knows that we're launching our CFO workshop series. We hope to open the registration process for a November 18th workshop at the Ritz-Carlton in San Francisco. And it's all based on the assumption that we can gather at that time, meeting all of the social distancing rules. And if we can't, then we will begin the workshop program next year, early next year. So thank you everyone for joining us. It was a great session, Jim. Thank you so much.
You're welcome.
Bye, everyone.